Hello and welcome to our discussion on financial statements and the process of converting business decisions into financial statements using the generally accepted accounting principles we call financial accounting. In this exercise, we will see the transaction of an existing business. An existing business will definitely have the balance sheet. So there is an opening balance sheet here, and the opening balance sheet shows the sources and the corresponding assets, and we can also see that the opening balance sheet can be converted into equation assets equal to liabilities plus equity, and at present the book value of the firm is 54, and the book value for the firm is equity divided by number of shares, and the number of shares is equal to capital by the face value. So this entity book value per share is 54. Now what we will try to see is, with these transactions, the new book value may be less than 54 or more than 54 because of the profits and the losses that the company will make during this accounting period. So let us see the transactions. So the opening balance sheet is there, so there is a opening cash in hand. Then with this cash we will try to find out what will be the closing cash in hand after these transactions. So sold 70% of this stock. So sales is 70% of the stock is sold for 300,000, and this 300,000 is not for cash fully. 60% of the sales is for cash. So 60% of the sales is for cash. As a result, the balance 120,000, 40% of the sales is in credit, and as a result the debtors will increase to the extent of the credit sales, which is 120,000 here. So debtors have gone up from 80,000 to 205,000 because there was a credit sales of 120,000. Whenever there is a sales, there has to be cost of goods sold because of the matching principle, and the cost of the goods sold is 70% of the stock available, and 70% of the stock is 105,000, and to that extent the stock will reduce on the balance sheet. So we can see that the change in the stock in this case is because of the stock sold, and stock sold is 70% of the stock available. And bad debt, during the period there is a bad debt of 10% of the old debtors. So 10% of the old debtors, and old debtors is 85,000. Bad debt is a loss due to bankruptcy or insolvency of the debtors. Bad debt is irrecoverable debt. A debt, if it becomes bad, it becomes loss, and we charge it against the incomes for that period to determine the profit, while determining profit. So the debtor has come down to that extent too. So debtor, we have seen in this case the debtor was 85,000 minus plus 300 minus 180. Now debtor will reduce further to the extent of the bad debt too. So the debtor is a change in the debtor is due to credit sales and due to the bad debts. Purchase depreciation for the year on cost. There is a plant, and depreciation is a reduction in the value of the asset due to wear and tear, and in this case the rate of depreciation is given as 20% on the cost, that is 100,000. So depreciation is 20,000, and depreciation does not involve any cash, but depreciation is a reduction in the value of the asset. So the accumulated depreciation will be now 40,000. You can see that depreciation is a income statement item, is an expense for the period. Accumulated depreciation is a depreciation up to the period. And purchase stock for cash, we purchase stock for cash. Stock is now will increase to the extent of 85,000. So the stock available will go up by 85,000. Acquisition of asset resulted in outflow of cash. We can see the change in stock. The stock was there 150, stock sold 105, and stock purchase 85. So stock available is 150 minus 105 plus 85,000. Payment to the creditor. You made a payment to the creditor, and the creditor, 40% of the money due to the creditors were paid during this period. Creditors of 45,000. And this payment is not an expense but a reduction in the liabilities, and the liability here is a creditor. Payment, purchase know-how, acquisition of another asset. We purchased know-how, and that is a asset, and we paid 20,000, and this payment resulted in the acquisition of an asset called know-how. Know-how was not there. We acquired the know-how now. And the life of this know-how is an intangible asset which will give some future, which may create the potential for creating future cash flows. So it is an asset. It has the potential to create future cash flows, so it is an asset. However, it is most of the time it is for a particular period or a particular life. So the cost of that intangible is amortized or is allocated over that period because of the matching principle. And in this case, it says the life is 4 years. So we are going to amortize it over a period of 4 years. So by 4. And amortization does not involve any cash outflow, but it is the reduction in the value of that particular asset. Just for the sake of consistency, I have shown accumulated amortization, and later on we'll see the other methods of approaches of showing amortization in the balance sheet. So let us recap. So the amortization is the allocation of the cost of intangibles over the life. Here the cost is 20,000, life is 4, so therefore per year we are amortizing 5,000. And to that extent the value of the intangible will reduce in the balance sheet. Tax. The tax is charged on the profit. So first we have to determine profit, but before we determine profit we have to charge interest on the loan because of the accrual principle. So 0.12, and let us assume that we pay the interest. An entire expense is a payment, no payables or for interest. Since we have shown all the transactions, we'll find the profit. So profit, we give a name to that called PBT, profit before tax, and profit before tax is equal to 300,000 minus 150,500, and that is where comes the tax now. We'll say tax is on the profit, so tax is equal to 30% of profit, 149,500, and let us assume that we pay the tax immediately, so no payable left here. So tax is a payment and an expense, and profit after tax is a money belonging to the shareholder or the owners of the company. So profit here is 104,650, and this profit the management may decide to distribute or to retain. If no information is given, we'll retain the entire profit, and the retained profit becomes a source. So profit transferred to the reserves, that means we have not distributed the profit and retained the profit for further investment. Then we'll see cash in hand. Cash in hand is cash available minus the cash payment. Cash available is 280,000 and cash payment is 179,000. So cash in hand is equal to 280,000 minus 179,850. So cash in hand is 1,150,000, and cash is an asset. We transfer that to the asset side of the balance sheet. So income statement done, cash flow statement done. We'll close the balance sheet at the end of the year. No change in the capital, no change in the loan. So the total sources of the business is 501, and total assets will also be 501. So we can see that the transactions has changed the equity, changed the reserves, and it also brought in some more assets, and the business has earned a profit. Now what is the effect of these transactions on the book value of the firm? We can see that the book value of the firm has increased. An increase in the book value is due to the profits that they made during the period, and the profit has not been distributed, and entire profit has been retained. We can see that the change in equity is due to the profit that the company has earned and retention of that profit. So when we see a set of transactions, the transactions affect the balance sheet, income statement, cash flow. However, it becomes useful to observe the effect of this on the book value per share, and the book value per share is the equity per share, and in this case equity per share has gone up from 54 to 75, and increase in the book value of shares is because of the increase in equity, and increase in equity is because of the increase in the reserves, and increase in reserves is because of the entire profit being retained. Thank you.